Okay. Welcome, everyone. I'm just letting people into the room while we get up close to 1 o'clock. It's a pleasure for me to have all of you here with our special guest, Demitry Omrin. Hello to all the friendly faces and familiar faces. All right, so it's hit 1 o'clock now. So I'm just going to start by saying officially welcome to this edition, this October edition of Mediation Matters. Usually we have a discussion group at this session. Today, we're very grateful to have special guest Demitry Omrin talking to you about valuation. And Demitry entered the real estate valuation field in 1991, and he operates a practice in downtown Toronto. Most of his files relate to family law matters, and he's appeared in court as an expert witness. Recently, Demitry became an accredited family mediator specializing in property and support claims. It was my pleasure to be one of your instructors along that journey, Demitry, and welcome. And I'm going to turn it over to you now. Thank you very much.
Thank you, Marianne. Good morning, everyone. Pleasure to be here. Thank you for having me. So I think the impetus for this presentation is what I really wanted to start off with. A number is inherently positional. And when we talk about a number, it's very difficult to get resolution on its own. So having more knowledge about the subject matter would help many of us as mediators being able to strike up conversations, ask questions, probe, and do many things that would move the parties towards a mediated settlement. And so that's the reason I wanted to offer this presentation, to give people more knowledge of an area that's integral. It's normally the largest number on the NFP. And so for that reason, I think it's worthwhile. So I hope you find the information useful. I'm just going to go ahead and start off with the usual. There we go. Okay, just had it freeze for a second. So there are 3 valuation approaches by which people value real estate. And I say people value real estate because the true appraisers are people that buy real estate. I, as an appraiser, call myself as a title as an appraiser, but all I do is follow the methods and the thought process of potential buyers. And I reflect that into what's called an appraisal report. So that's all I do. And there's 3 methods or 3 methodologies by which people think, and they package them into valuation approaches, as we call them. So one way that people value properties that generate income is by valuing the income approach. You have gross income, expenses, net operating income. I'll talk in more detail about that momentarily, but the proxy for value is based on the income of the property. So anything that's an investment grade property, such as a multiplex, you've got, I'm sure, clients that have had multiplex properties, triplex, fourplex, and so on, retail shopping centers, industrial malls, office buildings, anything where the motivation to buy is an investment, where there's a return generated by the purchase. The next valuation approach is the one we're most suited to, the one that everyone relates to. It's by comparison. So what would someone pay for a substitute property? So if you have a detached 2-story, 2,000 square foot home in a subdivision area of Toronto, say 2,000 square feet, 15 years old, with a certain level of condition or upgrades, you want to compare that to something that someone would buy in place of it. That word substitute is critical. When you look at an appraisal report, you do want to see that the comparables used are substitutes for the subject property, or that they be bought in place of them. That's just because the principle of substitution means that the comparables can be extracted towards a subject, and that means that the valuation will be accurate. If you see a comparable that deviates so much that it wouldn't be bought in place of the subject, it's not really a comparable. It's there on paper, but it's not really a good comparison from which to extract value. That's really critical when you're reviewing an appraisal report, that you look at the comparables closely and you just say to yourself, would I buy this property, this comparable in place of the subject? If you say yes, it's a comp. If you say no, it shouldn't have been used. It's that simple. Then the last approach is the cost approach, determining the value by the summation of land and building. You do have properties that are very unique and there's no comparison to. So you can't go into the market and find, like, for example, house sales, you find many of them. There's many to compare to, so you can value the house. But you can't value a 3.5 million square foot industrial building. There's no comparable for a single family house that was partially being constructed, and at separation date, you don't have a comparable because there are no partially completed buildings in the area. So you rely on what's called the cost approach. What would it cost for us to buy the land? What would it cost for us to build the building? The value, the summation of those two numbers is our value. So a rare industrial building that there's no comparison to, the comparison becomes the cost approach. What would it cost us to recreate it? So you can see the comparison approach and the cost approach are close cousins. They're very much related. They're both based on comparison. They seem different mechanically, but they're based on the same underlying theory. The comparison approach assumes that the property is generic, so you can find comparisons in the market, whereas the cost approach assumes there is no comparison in the market, so the market becomes what will it cost us to recreate. So those are the three valuation approaches: income, by comparison, and then cost, land and building. That's really, in essence, the three valuation approaches, and that mirrors what everyone does. Then in more detail, the income approach that I first started talking about, we always assume that if a property is going to be bought for income, we start at 100% occupancy. So it's fully occupied. It earns $100,000 a year in income. You have vacancy and bad debt allowance of, say, 5%. You have effective gross income, and then you have operating expenses. Then you've got net operating income. For those of you into the accounting, NOI, or net operating income in real estate valuation, is EBITDA, earnings before interest, taxes, depreciation, and amortization. It's a high level number for a reason. Market value, the word market prefixing value, means that it's a universally accepted number. So if you pay $1 million for a property, and I do, it's the same thing. $1 million is $1 million to both of us. If we started with a net operating income figure that was specific to how the property is owned based on the taxes that the corporation pays and other specific considerations, it wouldn't be a universal number. It would be a specific valuation number to that entity. So for that reason, we make sure that the number, the net operating income number, excludes considerations that are specific to a company that holds it with specific tax considerations and other attributes that we don't want in that number. So the net operating income, again, is EBITDA, earnings before interest, taxes, depreciation, and amortization. The operating expenses, leases are done on basically two ways, gross terms and net terms. If you see a lease that's gross, so if the owner tells you, if you're mediation, you're in a mediation or you're asking for disclosure in your financial disclosure request, and you ask the party for information, if the leases are, they pay a certain amount a month plus expenses, that's a net lease, meaning net to landlord. So the landlord gets the net lease terms and the expenses are paid by the tenant. If the tenant pays an all-inclusive rent, so they pay $2,000 a month, includes everything, that's called gross terms. So then you have to deduct it on our operating expenses here, right here, 35,000 total operating expenses. The 35,000 means that the rent included the expenses, so therefore we have to deduct them. Because remember, we're determining what the net income would be to a buyer, an investor, so therefore they have to be deducted. If you saw no operating expenses here, if this 35,000 was zero, which it is sometimes, that means that the tenants are paying on net terms, meaning they pay their rent plus their proportionate share of operating expenses. Because that's simple, really. And then at the bottom, we've got the formula, with basic formula we use, the Irv triangle. This just means the cap rate. Cap rate is capitalization rate. So we take an income figure, we want to convert it to what it's worth in capital dollars. That's why it's called a cap rate. So the cap rate itself means that the property was purchased for cash. Again, we're not considering specific financing arrangements or anything specific to one entity. We want to know what the universal market value figure is. So based on that, we assume that there's no financing. It's bought for cash. So if you see at the bottom 10% cap rate, that means someone bet 100,000, they were going to get back 10,000 a year. That's a 10% return. No financing, very clean consideration. In this case, 60,000 a year in income with a 10% cap rate gives us a value of 600,000. That's in this formula, the Irv triangle. So you see IRV, V is for value, income over the rate or cap rate gives us the value. It's that simple. So again, we just consider if it was bought for cash. If we consider otherwise, we would complicate the number and it wouldn't be a universal figure, universal market value. It would be some other specific value to the entity that owned it. Any questions on that?
So far, no, nothing. Yep,
Okay.
yeah, it's good.
Okay. The next one is the comparison approach. You've got basically the one approach what everyone accepts. This would be applicable to anything. The concept of value applies to everywhere. Whether you're buying a car, an expensive piece of jewelry, a house, commercial property, the notion, the underlying principle of value is the same. You want something that someone else has, what do you have to give to get it? That's all we're talking about here. So you compare. When you buy a car, you comparison shop. When you buy a house, you comparison shop. So you look for a house that you want with certain attributes, you compare other properties for sale, you adjust for differences, and you come up with a value that you're willing to pay. That's in essence what the comparison approach is. So in this case, we've got three comparables. We've got the subject on the left here. We've got its attributes, lot size, building size, no ravine. And then we've got comparable 1, 2, and 3. So comparable 1 sold for 300,000. And then it was inferior in terms of building size. So inferior means that we have to adjust it to be comparable to the subject, because at the bottom, you'll notice there's an adjusted price. This adjusted sale price at the bottom. So we started off with 300,000 sale price. We have an adjusted price of 305. That's because when we're talking about an adjusted price, that is a proxy for what the subject is worth. After we've made all adjustments and we've accounted for differences, now that comparable property is the subject property on paper. So it's inferior by lot size. It's a 40 by 120 lot, whereas a subject is a 50 by 120. So if it's inferior, we need to bring it up to be on par with the subject. If it was better, then we have to bring it down. If it's superior, we need to bring it down towards what the subject is. It's that simple. If it's the comparable is better, we're bringing it down to the subject. If it's inferior, we're bringing it up towards it. Right, that's all we're doing. So that's comparable 1. There was one adjustment just for the lot size. Comparable 2 was same lot size, 50 by 120, just like the subject. It was 2,050 square feet. The subject was 2,000 square feet. So 50 square feet is not enough that a typical buyer would notice. So we would typically not adjust for that. If someone's into a property and they can't tell the difference, if they can't tell the difference, then it's not something we would normally adjust for that reason. That's simple. So in that case, comparable 2 required no adjustments. It's sold for 305. Now we've got two comparables, comparable 1 and 2, that have adjusted values of 305 and 305. The third comp, we normally use more comps than these in an actual report, but this is just for illustration. So comparable 3 had the highest sale price at 325. So we know there's something unique about it. It's same lot size, smaller, so it's inferior in that respect, but it had a ravine view. So that was much more superior by 30,000. It was worth 30,000 more. So that 325 needs to be brought down, but it needs to be brought up for the fact that it's smaller. So the adjusted price is 310 after accounting for adjustments. So at the bottom, you notice you've got 3 adjusted sale prices, 305, 305, and 310. Those should be close. So when you see an appraisal report and you see that the valuation adjustments result in an indication of value from each comparable that are tightly arranged with each other, then you know that they've accounted for all the adjustments. The appraiser has done their job. If you see a range of 305 to 390 or 305 to 450, that kind of variance is saying on paper that the value of property is either 305 or 490, which is impossible. It's one or the other. So valuation is not an exact science, but it should corroborate each other. The findings, the analysis should corroborate each other. So you should have adjusted sale prices that, after making all the adjustments, support each other and would be a proxy for the subject's value. Okay, that's the comparison approach. That's all we're doing there. When you see the adjustments, they need to make sense, and the adjusted sale prices need to corroborate each other, need to be within a reasonable range, because otherwise it shows that you've missed something, and the range that's very wide is telling you that there's 2 values and not 1, which is obviously impossible.
Demitry, can I ask a question about that?
Sure.
How many comparables do you normally use? You said this is just for showing us, but how many would be typical in a comparison approach evaluation?
Sure. So on a residential, a minimum of 6, just to give the report some weight, typically 6 to 9. So if we have good comps, we'll use 6 and leave it at that. If the comparisons are relatively weak, maybe not so clear, then we'll use more just to substantiate the valuation finding. We assume every report's going to court. We use that threshold. So we know that it's going to be scrutinized and questioned by the opposing side. We know that most of the files do not go to court, but we assume that on the premise that the report needs to be done to that level or that standard.
Okay. And then you mentioned something about the view and then the $35,000 view for the ravine. How do you determine what view has what value?
Sure. So we do what's called a pairing analysis. So we look at two properties that are similar or otherwise, except for one has an attribute that we're trying to isolate. So two properties are the same age, same building size, maybe same street or same area. One has a ravine, one doesn't. The one that was on the ravine sold for 30 to 40,000 more. So we know that's our adjustment. That's called a pairing analysis. Yeah.
Okay. I wondered if there was a chart somewhere that could say if you have a view of hydro poles, you come down by 10,000, but it really is just specific to that area.
Yeah, there actually are studies, but I have an issue with the studies because they change, the adjustments change over time. When valuations go up and down, the sale price is changing. So all those components that were in the value have changed as well. So in a down market, valuation adjustments change. In an up market, they change as well. Some things don't even get adjusted for when it's a seller's market because either you take it or leave it. You've got no choice, right?
That's right. Okay.
Like a negative attribute, I'm often told, what about a negative attribute on a property? And if it was, 6 months ago, 8 months ago, adjusting for a negative attribute was difficult because people are in bidding wars. So it's hard to quantify a negative when people are wondering how much more they need to pay, right?
And so you really have to have your finger on the pulse of all of this as a evaluator and just like understand what's going on at the moment. And how long would your valuation be valid for in this market specifically?
So that's a great question. If we use a comparable from last week and there was an announcement today on interest rates that triggered the market to react, that sale's already stale. If the market is constant, then it could be months when that comparable can still be current, still valid. So evaluation we did today, there's an interest rate announcement October 26th, and I think December 7th or 17th. So as those kinds of announcements have a profound impact on the market, that may change and that may make an appraisal stale. We've been dealing with that since March 2nd was the first interest rate increase. And there have been people that have had to settle quickly because they were on the wrong side of the valuation market.
That's right.
Yeah.
I've heard people talking, my clients talking about, oh, well, the interest rate's going to happen. So now my house is worth more because it's available. Is that true, or is that kind of wishful thinking?
No, not really. If you're getting into the market now for the first time, you're actually in a good position because you're paying less, you're financing less. So the interest rate is higher, but you're financing less. So when I started in 1991, I started real estate in 89, interest rates were 14%, but the property was 1/7 or 1/8 the value it is now. So actually when you do the numbers, you weren't better off now than you were then because you own the equity. You don't own the equity today. You own what you financed. So there's a bigger purchase price, but that's mainly financed. Whereas before you paid 300,000, that home now is worth 1.3, 1.4, 1.5. So it's worth 4 or 5 times more, but that's mostly financed for people that are buying today. Whereas you owned it back then and you were financing a fraction of what you would today if you bought it. So,
Okay, good, thanks.
Okay. I talked about this earlier, just talk a little more about it. The yes/no test for comparables. I can't emphasize how important this is when you're picking comparables in a report, to be included in a report rather. The yes/no test, as I call it, something I used to talk about when I used to teach valuation at university. If the comparable is deemed as a substitute, therefore you can use it as a comparable. So it can deviate slightly. It can be a detached two-story. Your subject is detached two-story, 2,000 square feet, 15 years old, subdivision. You can use a property that's in the same subdivision that's a bit larger, but you wouldn't use a property that's 4,000 square feet to compare it to a 2,000 square foot home. You don't buy that in place of a 2,000 square foot home. So you normally wouldn't use that. The only exception would be when there's nothing to compare to. In down markets, when there's less an abundance of comparables, then you wouldn't have a choice. But under normal market conditions, which we are now, this is a balanced market. In my opinion, yes, it's going down, but we've only had a decrease in valuations over the past year and a half at the most so far. So valuations have been rising for 20 years. to go down 1 year's worth of increases is not a bad thing at all. So we need to keep perspective, in my opinion, because there's a lot of negative sentiment out there that becomes a self-fulfilling prophecy if we're not careful about it. So the yes/no test is critical, as I mentioned before. If you have the comparable that is substitute, you would use it. If you don't, if it's not something you'd buy, if it deviates too farly from the subject, then you'd say no to it. Don't assume, a lot of people in our field assume that because they are designated appraisers that are accredited, that people will believe them. Nothing could be further from the truth. A court file that's going to court, even when you do a good job, the other side, when they're advocating, will try and find things to poke at. That's just the way it is. That's the name of the game. In mediation, obviously, it's a different realm, different world, but it doesn't excuse the fact that the appraisal should be convincing. An appraisal report's not written in a vacuum in terms of technical valuation terms. We do mention things to take out arguments between separating parties. So if we know that the market is sliding one way or another, we will mention it. Just take one less thing for them to talk about. So it's not just an appraisal report, but we understand what they're going to be talking about, so we address them in the report. Okay, and then the last approach, I talked about the income approach for investment properties or commercial properties, the comparison approach, and the last one is the cost. So as I mentioned before, the land value at 100,000, depreciated building costs at 200,000. You have minor site improvements to add to that, you get a value of 310. This would apply, as I mentioned before, to either partially completed properties where there's no comparison in the open market. So the comparison becomes, what will it cost me to build and buy the land? Or very unique properties that there is no generic comparison in the market. A very large industrial grade property, a 3 million square foot industrial building, there's just no comparisons to it. So the comparison becomes, for a buyer, what would it cost me to build it? And that's when the cost approach would apply. Okay, so just a little rough exercise here. Which valuation approaches would apply? We just recently did a Sikh temple. In terms of the valuation approach, we used the cost approach. We did use comparison. We did find some comparisons. They weren't the greatest comparables. It just wasn't available. But certainly there was more weight placed on what the land value is. What would it cost to build? There are some conditions attached to very unique properties. So the demographics have to be in place, and the valuation or the financial health of the nonprofit corporation that owns the temple or the place of worship has to be solvent. Those two conditions are very important for the value to be there. Otherwise, it's not really market value. It's just an open market transaction where no one would want the Sikh building. They would just buy the land. So it's either worth 17 million or it's worth 4 million just for land. So it's the cost approach would be in that case, it's so unique, there's nothing to compare to, the way to go, land and building. 50,000 square foot industrial property. For something like that, there's many buildings of that nature. So we can find comparables, 50,000 square foot industrial properties all day long. So certainly people would be able to, a prospective buyer would be able to go into the market and look at other 50,000 square foot industrial buildings and be able to say what they sold for and be able to compare. 3.5 million square foot industrial property, as I mentioned before. The comparison now becomes, what will it cost for us to build? Single family home, obviously by comparison, you comparison shop when you're buying a home. Partially completed single family res property. As I mentioned before, you're not going to find comparables in a healthy or balanced market where they're partially completed. So the comparison becomes, what would it cost me to buy the land? And I'll pay the owner the cost to build plus a premium because they've put me ahead of where it would have been if I had to do it on my own. So that would be the cost approach in that case. And we've done that before. Last year, we had a divorce in the bridle path. The property was worth partially completed 8 million. So it was land plus the value of the construction that was there as a separation date. And the fourplex at the bottom, it's a small scale investment property. A 4-unit residential property is considered a small scale investment in relative terms, especially in Toronto market, GTA. So that would be, you'd get some, you'd find data where there's comparisons in the market from which to value it, another fourplex that's sold. Those are fairly generic properties, but you would also corroborate with the income. What is the value by income? So you've got comparisons. If they're saying, if the comparisons in the market are saying that the property is worth about $1 million, and by way of income, you get a value of 1.1, those two numbers corroborate each other. They're fairly close. So you can say that the value is either one or in the middle the midpoint, and therefore that's the valuation as at whatever valuation date you're using. So that's just an exercise on how we determine which approaches to use. Renovation impact. The way I like to explain this to people is the people make their buying decision of buying a property, especially a house, largely on emotions. Yes, they're looking for certain attributes that are, on paper, location, building size, condition, and so on. But a lot of people that they walk into a house, they make the decision within a few minutes of when they want to buy it, when they see it. So the first impression is very important. The curb appeal, the front entrance area, you should spend, if you're investing in a property and you want to increase the value, very, very much important to make a good first impression. We all know about kitchens and bathrooms, that they add value. Flooring, decor, how the property shows, how it visually shows. That's why people do staging and why it is perceived to add value. Most important rooms are kitchen, bathrooms, and to some degree the master bedroom, excuse me. In my house, I had a 4-bedroom home. I converted it to a 3-bedroom. So the master bedroom is half the second floor. It has a master bedroom area plus a sitting area. So someone that wants a 3-bedroom home would probably pay at least the same as a 4, if not more, because it's a unique 3-bedroom. It doesn't mean that just because there's 1 bedroom less, they're going to pay less for it. The master is an influence in this case, and usually those are the decision makers that decide who's going to buy which property we're going to buy. So the master is not often mentioned, but I found in my experience that it is influential. And at the bottom, I talk about the values and the details. The picture on the left and right are in contrast to each other to some degree. The one on the left being a more basic kitchen, the one on the right having more details, the vent hood, the wainscoting, and other attributes that it has. If you spent $30,000 on a kitchen and you spent another 10 on the upgrades, the 10,000 upgrades will have a much more greater return than the initial 30,000. The values in the details, all the details that you put in. The only exception to that would be what I would call, or what everyone calls, minimalist design, the very sleek, modern, ultra modern, which can be to some perhaps a bit austere. But generally speaking, it's always been the case that the values in the details. The initial cabinetry and the big items are important, of course, obviously, but what you embellish with is what really adds value. Okay, just going to talk a little bit about the pandemic and what we did to value during the pandemic. A lot of people were saying that there was no value to an appraisal during the pandemic, which couldn't be further from the truth. So initially, when we had the lockdown, I'd never experienced something like that in my career. I didn't think it was legally possible to even shut down an economy. So what we did was, I've talked to you about the valuation approaches and how we rely on information. If that information didn't exist, what we did is we asked people, we surveyed people, what would you do in lieu of a transaction? So what would you do? Would you pay the same? Would you pay more? Would you pay less? So shortly after the pandemic started, we had the CERB, Canada Emergency Response Benefit. We had other economic stimulus that made the market robust. Instead of collapsing, the market actually took off. So they didn't know all of that up front, but we just asked people, what would it change your opinion? Would you pay more or less or the same? And that's what we use as a proxy for a comparison. If there is no comparison in the market, a comparison becomes, what will someone do? In the recession years, when there were no comparable transactions in certain markets, we would survey people and ask them what they would do. We would ask real estate agents, what offers did you have on a property? So the word comparison can be defined to be many things: an actual transaction or something in lieu of a transaction. And that's what we had to work with at the onset of the pandemic. Now going back, if there's a separation date in early 2020, we have the data, we have a degree of hindsight. But at the time, it was very challenging, and we had to scramble really to get our handle on what people perceived. If you had deep pockets in commercial real estate, it didn't change much for the first initial part. Residential people are very sensitive to what they hear on the news, very emotional. They're very much more reactive. So that was more challenging to get our handle on what was happening. But the way to do it, as I say, is to get a proxy for what they would do in lieu of an actual transaction. What would you do if you were going to do it now? So that's how we dealt with it in the beginning, because I remember hearing many prominent economists that an appraisal is of no value. If a property has value, an appraisal is worthwhile. If you want to know what it's worth from an impartial person, or wherever you get the value from, on your own or however, as long as a property or any asset has value, an appraisal is relevant. And it's really that simple. So I talked about surveying the market participants. At the bottom, I just want to point out to illustrate, surveying people and taking the approach we did was no different than previous economic downturns. In April 20th, 2017, the Ontario government announced a foreign buyers tax that had a pronounced significant psychological impact on the market. So overnight, the market changed and there was no new data. So to me as an appraiser, objectively, taking out the word COVID, taking out the stigmatization of COVID, those two situations between 2017 and the pandemic in 2020 are no different. There's no data because there was a pivotal change in people's mindsets one day for whatever reason. And in both cases, we just found out what are they going to do by asking them as a proxy for a comparison. That's all. There's no different. Okay. Further implications, and I think I would say more recent, what's happened after the pandemic. I've said this many times, but in my view, the pandemic really has brought to the surface things that were already there. If someone was in a bad relationship, it came to the surface during the pandemic. And we know that from the number of files people separating. If someone had a strong balance sheet, deep pockets, money was worth more. If someone was having financial stress, it became worse during the pandemic for the most part. So it was more of an, I would say COVID was an accelerant. It just brought to the surface what was already there. So the value of strong balance sheet versus a weak balance sheet, the value of money went up. If you had money, you had leverage over people. The consolidation of capital would be another one that would tie into that. The larger buyers of real estate, the pension funds, the REITs, real estate investment trusts, they have very deep pockets and they have what they call, in commercial real estate, they call dry powder. Dry powder is a lot of cash sitting around waiting to be invested. So by being able to do that, they've got a lot of leverage. So money's worth more in bad times. A strong balance sheet gives you more leverage over people that are in financial distress. In my opinion, the second last point at the bottom of the slide, greater consolidation of mergers. In my opinion, in 10, 20 years, there'll be less people able to afford the larger, medium to larger scale real estate. And the only buyers will be very large consolidations of either pension funds or REITs or otherwise. And consortiums, people getting together, families or people within ethnic communities, because it's getting to the point where, although now people think the market is declining, in certain asset classes in commercial, it's not. Rents are going higher. So a rental property like a multi-residential building is still holding well. Industrial is holding well. Other assets are having challenges. Single family res, we've seen anywhere from 5 to 20% so far. Would depend on the location and the supply. There's still bidding wars in Toronto for houses to this day. So the market still is quite healthy. It's just a matter of looking for that information and taking out the extraneous information we hear online or otherwise. The other impact it's had is people financing, lenders' assessment of growth. We've had many conversations with our lender clients, aside from the work we do in litigation, where they didn't know how to assess clients that suddenly grew during the pandemic. They had businesses that were doing well, but they exploded during the pandemic. They didn't know whether that was sustainable to be able to lend them money to buy buildings. So it was a challenge for lenders to be able to assess their credit worthiness, if you will. So the pandemic created a lot of challenges, created a lot of opportunity. I probably wouldn't be a mediator if it wasn't for the pandemic at this point. But you know, we don't take solace in the suffering of people. We just provide a service, and that's the end result of why we're here. Okay, just a few words on the economy. I'd be remiss if I didn't mention that. When we started the pandemic, everyone expected a recession, and that usually is defined by what's called an inverted yield curve. So you have high interest rates or high costs of borrowing upfront now and lower costs down the road, which means that there's high risk right now because there's uncertainty, but down the road it's expected to smooth out. So therefore, there's going to be an inverted yield curve. You see at the top here, yield high upfront, and as you go further down the road, the time maturity, the rate goes down, the cost of borrowing goes down. So whenever in finance you hear inverted yield curve, that's what they're referring to. What stopped that, frankly, was that even financial institutions were hedging against losses by increasing their reserves. What stopped that was the government intervention with CERB and quantitative easing. CERB was, if we all know, there's that $2,000 a month. A lot of people don't know that CERB was rolled into unemployment insurance. So It's still easier to get unemployment insurance than it was pre-pandemic. So there is still CERB light, if I can call it that. And then there's also what they call quantitative easing. Quantitative easing is simply when the government, the Bank of Canada, goes into the financial markets and they're essentially lending money. They buy bonds. A company that wants to generate capital to grow can issue a bond. And it's just basically saying, we want this amount of money on these terms. Are you interested in buying? If you buy, you're lending us money. So if I buy a $100,000 bond, 3 years in certain terms, I'm lending that company, that corporate entity money. That's what the government would do. That's what quantitative easing is. So they're lending money, they're stimulating growth. Usually it has the effect of lowering interest rates. So it's when they want to grow the economy. Now we're in the reverse. Instead of quantitative easing, we're in quantitative tightening. So those bonds that they would invest in, they stopped. They're not buying anymore. They're letting them expire. They're not helping companies grow like they were before because they want to put the brakes on. So that's what they meant by quantitative easing versus tightening. That's all they're talking about. The long run implications of the quantitative easing when they made money much easier is people had more money in their pockets, the money supply increased. And when there's more money in the money supply, it's basic economic theory that it will be picked up by vendors and prices go up. And that's why we have inflation at this moment. Just talk about that a little more. In response to that, the Bank of Canada, this is the chart here I got from their website. It went from, I'll just highlight it here for you. In January, end of January, 0.25. They kept increasing it. Now it's 3.25%. So it's went up 13-fold. The policy overnight rate. The policy rate by the Bank of Canada is not the actual rate that you'll pay. It's more of a symbolic gesture as to whether they want the economy to be in economic stimulus mode or economic brake mode. So when they increase the policy rate, or the overnight rate as it's called, when you hear the next announcement, all they're saying by increasing it is, we want the economy to slow down. We want inflation to be under control. That's all they're doing. If they increased rates, that's what they're doing. If they decrease rates, it means they're injecting economic stimulus, like we all know. So the 13-fold or 1,300% increase since the early part of the year has had a significant impact on people that are buying real estate. They were qualified, people that bought real estate previously were qualified on what's called the benchmark rate. So notwithstanding the fact that you could get a mortgage in January, a 5-year mortgage for about 1.75%, you were qualified on a benchmark rate of about 5.25%. So that was what they called the stress test, if you heard that term before. So if you qualified under the 5.25 benchmark rate, you're only paying 1.75. You had quite a ways before you were financially strapped or under pressure, financial strain. We're at the point now, we're at the threshold where another 1 or 2 increases are going to cause some people to wonder what they'll be able to do. So right at this moment, what the banks are doing is, instead of increasing the payments, they're going to increase the amortization rates. The amortization rates on a mortgage are simply the amount of time it takes you to pay it. So a longer amortization rate decreases the payment. So usually the mortgages are based on 25-year payment term or 25-year amortization. So if they increase it to 35 or 40 years or even more, I know one person I know, they have a mortgage where the amortization is now to 60 years. And that's because they're trying to keep the payments the same. Anyone that had an open mortgage, they're keeping the amortization at sliding upwards to offset the increase in payments that would otherwise be. And that's how they're trying to keep them in their home. If they didn't do that, and they had to come under the new terms of the new interest rates, the payment would go up by about almost twice, almost double. So that's going to be problematic, and that would create more supply in the market and possibly exacerbate valuation declines further. So I think that's going to be avoided. That's what I'm hearing on the street. And hopefully that will be the case where they just increase the amortization rate or smooth out the payment over a longer period, so we don't have to worry about budgeting as much. The Bank of Canada, Tiff Macklin, I recently heard him announce that he's setting a 2% inflation target despite the 8%, core 5%. 8% is a volatile number right now because it includes energy and food. Food prices and energy are very volatile, as we all know, especially gas prices, the way they've been going the last 6-7 months since what's happening in Eastern Europe. So we tend to use the core inflation rate that's more stable. The core rate is about 5% right now. I think it's actually about 5.5, but I use 5 just as a round number for illustration. That number they want to see go down to well below 2%. In order to do that, they're going to have to increase rates more. But of the G7 countries at this moment, our interest rates are the highest of all the G7 countries in the world. So we think, and many people think, the school of thought is that the Bank of Canada have left room for them to decrease rates next year, which is a good thing. It's a positive outlook. By early to mid 2023, it's expected that they'll start to reduce interest rates very, very slightly, just to signify that we're at where we want to be. The economy is slowing down, inflation is under control, hopefully, and therefore we don't have to continue to increase rates. The last increase rate for this year will be in December. They think, a lot of people, economists think, that that will be the last one, and that it will hold steady into early 2023. And by mid 2023 is when we'll start to see, hopefully, some declines in the rates. The one caveat I will say, though, is that at the very bottom, the last point I wanted to make, the rising interest rates are less effective right now, only because the inflation is coming from companies being able to raise prices on goods and services. It's also called, you see it online, it's called, some companies are being accused of profiteering and taking advantage of supply chain issues when they don't exist in every case. So unless there's legislation to curb that type of profiteering, if it is in fact going on, then interest rate increases won't help curb inflation. And that would be a problem, because that's called stagflation. When you have an economic downturn or a recession even, and you have inflation. Normally when there's a recession, prices go down, but in stagflation, you have the opposite, where you've got a recession or down period, plus prices are still going up. That would be a very difficult thing to deal with, and it would be a last case scenario. It's not expected that that would be the case, but when I hear Tiff Macklin talk about an inflation target of 2% and it's at 8%, the only thing in between is that there's going to be further rate increases, at least for the next couple of them. And hopefully what the economists feel as to interest rate increases only till the end of the year will come to fruition, because I think we're at the point, as I say, where people are at the point in their mortgage where they can't really afford much more increases that are bought a year or two ago. Okay, that really is in a nutshell. I hope that was high level, just to give people food for thought. There's no math. I promise no math to Marianne. There's no math. So.
Thank you, Demitry. I had a few questions and encourage you all to either unmute and ask your question or put it in the chat, and I'll read it for you. But when you were talking before the COVID piece about the values of kitchens and bedrooms and all that kind of stuff.
Yeah.
Oftentimes couples in our mediation rooms have trouble making a decision on, like, hey, I want to paint the house and fix the deck before we sell it. And I'm often referring them to their real estate agent to, if they've picked them and they trust them.
Yeah.
However, that's not always the case. Can they also speak to their evaluator? Like, can they ask you, what do you think would be the best things for me to do to get the best price for my house if I am selling it?
Sure. So they can speak to their trusted real estate agent. They know the market that they work in, certainly. An appraiser's role could do the same thing. The appraiser offers the same value as value, whether it comes from the real estate agent or the appraiser. Value is value. Both of them have understanding of the market. The difference with an appraiser is, I've noticed when people hire an appraiser, they want to know that there's no other motivation for us. So we charge a flat fee for the valuation, and that's it. They want that assurance. That's our value proposition to litigants in family law, especially.
Right.
But fixing the deck, Marianne, some things are still good to do, notwithstanding the fact that they may not increase the value. When people are buying a house, it's a major, we all know it's a major financial decision. You don't want any impediments there. So if the deck is looking shabby, they should sand it and stain it if they could. It's not going to increase the value. It's a minor item, but don't have anything looking that it's not been maintained, right? And anyone would tell you that selling real estate, right?
So it makes a lot of sense, especially in the market now, to make your house stand out and be sort of polished at this stage.
That's right. Absolutely. That's what people are doing right now. Yeah.
Okay. I loved the optimism about the financial picture, right? And it's I hope that we can share this recording with our clients too, because I think a lot of people are really afraid. Right now, there's a lot of, I'm doing a lot of deferred sales of the matrimonial home because people want the market to catch up. I was really interested to hear that in Toronto, there's still bidding wars. My clients haven't had that good luck. And I think that it's when you said about 2023 and there might be a signal down in the interest rates, do you think that deferred sale of the matrimonial home is it something you're doing in your mediations, and what do you think about it?
Yeah, I'm not recommending it only because when I say to them what the closest I'll come to a deferred sale personally is
Yeah,
to say this is what we know now. We can only work with what we know. This is what we know. These are the variables in play, because predictions are uh, very much inaccurate most of the time, because the variables that we use to make predictions constantly change,
right.
right? So that's my problem with predictions. I've made predictions personally, but they're usually wrong because all the variables change. There's no constant. Um, so that's the problem I have with that. But the deferred sale, I think, might be risky. If the market does change significantly, it'll be reopen the negotiation for sure. You know?
Yeah, yeah. And
Yeah.
I mean, deferred sale I did last night was a family who like wants to live in the same neighborhood. Mom rented an apartment close by, dad's keeping the house, and we're just working out like how to pay the bills and what if the furnace goes, roof goes, that sort of thing.
Right.
But their intention is actually to hang on to the house till the market changes. And interesting CRA question that popped up that I think I got an answer for, and I'm going to throw it out there in case anyone else has information. But on a deferred sale of the matrimonial home, does mom in this scenario have to pay capital gains on the sale of the home? Now, I talked to an accountant friend last night as well. Well, a CDFA who had an accountant friend who told me that showed me an article from CRA that as long as the child lives there and the spouse lives in the house and there's no other principal residence declared, that they can actually avoid that capital gains tax on sale in a few years. So I just wanted to throw that out there and see if anyone, Demitry, if you know anything about that.
Yeah, my mentor was a CDFA, and who I
Yeah,
mentored with, and we came across that.
yeah,
So I'm familiar with that, but you do need to be careful, because a
yeah,
deferred sale, we don't know what's going to happen in the market. These are uncharted territories.
yeah,
So as long as they know what they're getting into, we're covered as a mediator. So I just say to them, these are the variables in play right now. It's
yeah,
expected, the way I was presenting, I was talking about they're expecting, interest rates to stop rising by the end of this year, and then hopefully by first or second quarter of next year to start to either ease off or at least stay stable. That's the expectation right now. That seems to be the consensus. Whether that comes true, no one knows. So I just make sure I always put that caveat in, because I know that it will reopen the negotiation if the number deviates significantly from what they thought it would be worth now.
right. Yeah, the prediction piece. There's a question from Linda. She's saying there's a prevailing belief amongst family lawyers that formal appraisals are lower than opinions from real estate agents. I would have thought the opposite, Linda, and therefore beneficial to the spouse who is buying the other's interest. Can you please comment on this? So I'm just going to read that again, make sure I got it right. There's a prevailing belief among family lawyers that a formal appraisals are lower. So the values are lower than opinions from real estate agents. Yes. Okay. I follow you now. And therefore beneficial to the spouse who's buying. So that's what Linda's saying. Hey, the values coming out of valuators are lower than real estate agents who might be more optimistic. What are
Mhm.
your thoughts, Demitry?
I've heard that before many times, actually. I'm surprised to always hear it, because value is value at any point in time. So if we're both, for real estate agents giving an opinion of value as of today, and I'm doing the same, value is value. It should be more or less the same if we both did our job correctly. So there's no difference because of who did it and the title of us. But if we did our research, if I made a mistake or if the other agent made a mistake, then that's obviously different. But there's no real inherent reason based on our roles in family law why one would be different. No, I hear that a lot, quite often.
Yeah. I
Yeah.
mean, I've heard even in mediation where people are saying, oh, well, that's their agent that they got to value the house was their best friend's golf partner's wife's cousin, and that is why the value is high. Or as simple as like, oh, that real estate agent just wants to get your listing, and that's why the value is higher than this valuation.
Right.
Do you see the valuation as sort of more scientific without the worry of that non-neutrality popping in, Demitry, for evaluator?
Yeah, I like the fact that you use the word scientific. When we interview people, we ask them on a scale of 1 to 10, are you 10 being ultra scientific or 10 artistic? And the best appraiser is a 7. You have to be able to analyze and be able to step back. So it's part art, part science. So it's a great question. It's a very, very relevant question. It goes to the essence of being an appraiser. If we're too analytical, we're not able to step back and see the big picture, and our valuations will be on paper looking perfect, but they don't resemble what really goes on in the market.
Right.
So yeah, no, it's very important to be able to take a step back and look at the big picture. Does this make sense? Because the numbers can fool you sometimes.
Right. I've heard of something called a purview valuation, which I've never really understood. Can you
Yeah,
talk about that for a sec? Yeah.
sure. So Purview, and there's many services like it, they brand themselves different names, but they're all based on what's called multiple linear regression analysis. So the tax authority, the Municipal Property Assessment Corp, that assesses all property for tax in Ontario, they appraise property not one by one, because obviously they couldn't get to everything. So they put all the property attributes into a database, and they use a statistical model to value every property by what's called regression analysis, linear regression analysis. So either the value is bang on or it's way off. It's a hit and miss, right? So it's not something I could recommend for family law or any situation where the people are looking at equalization. They want an accurate number. It's their only chance. It's their last kick at the can. So I don't recommend it. It's really applicable. Mostly lenders use it. So if the loan to value ratio, if they're lending on 50% of the value, and Purview says it's worth 600,000, but it's really worth 8, and the parties only want 200,000, then no one cares what the real value is, right? The Purview would be more than adequate. But for an equalization on the NFP, I can't imagine someone relying on a number that could be bang on, way off. It's just a hit and miss. Yeah.
You actually raised a really good question that I had, or thought that I had, about that big piece of the partners qualifying to buy the other person out. So the first step is like, let's agree on the value. And then, so the banks are using this purview value to qualify the house for the mortgage mostly, or?
Yeah, in some cases they are. In some cases, they order an appraisal. There are some alternate lenders that until recently were doing up to 80% loan to value ratio based on Purview, or something like Purview, where it's the same thing, just a different brand name. So
really?
They didn't see risk because the market had been going up 20 years. So there weren't losses. The problem with that is when there is a loss, you're gonna feel it, right?
Right.
So no one really, to be honest, nobody really wanted to see or to hear about the market declining for years. I do commentary and articles 3 times a week. I wrote my first article in 2017 when people were buying real estate the last 5-6 years with interest rates being unrealistically low. They weren't really buying real estate. They were buying into money. If they have to sell because their interest rates go up, did you buy real estate or did you just temporarily rent money? It's the latter. You didn't buy real estate.
Okay. If you were doing that in 2017, what's happening in 2025?
And that's a great question. If I knew, I would make some investments in the markets and sit back and wait for them to grow. Yeah, no one knows, but I certainly hope that the consensus that interest rates will stop rising by the end of the year and start to go down next year. I think it will, only because many things, but we've really overshot the increases. They've been quite unusual to see. I've never seen increases this much in such a short span of time. So it's really created what I would call a shock to the market.
Yeah.
But when you see listings, when you're looking at an appraisal report, and in the grid section, you'll see days on market. You can tell the pressure on the market. If it sells in 6 days on market, there's probably a bidding war there still in that pocket of the city.
Right.
If you see days on market of 40, then that's more of a balanced market. In the recession years, we saw 90 days, 120 days or more, right? So the days on market is very important for any mediator to look at. It tells you not the value, but it tells you the direction of the market. And that's usually on the report.
Oh, that's interesting. And then I've got another thought, and I don't know if you have knowledge on this or not, but I've heard about the 2 things. One, a little older, which is the use of the home buyers plan for separating couples to access capital for the investment. And then the second thing I've heard about recently is coming out in January, the home buyers plan / TFSA / RRSP savings account. That's the best way I can describe it. Do you know about those things?
Yeah, I know a little about them. That's more of the financing, the brokerage.
Yeah.
But I do know a little about it because I was intrigued by when it first came out.
Yeah.
You heard of those concepts, equity sharing, where the government would share in the equity of your first purchase if you had insured by CMHC. You guys may have heard of that. So they call it equity sharing. It's another form of capital gains. So I don't remember the numbers, but you buy a condo in Toronto, let's say, a couple, young couple buys, and they share in the equity gain of that condo unit with the government.
Oh,
Yeah, so they're calling it equity sharing, but it's really capital gains on some properties. That's all it is.
okay. So I've not even heard of that one. I was thinking
Yeah.
about the home. So there's something else. And is that program still available across Ontario? Is this just a Toronto program? Yeah.
Canada-wide. That program it's federal, so it's Canada-wide. It would more apply to markets where there's affordability issues like Toronto and Vancouver.
Okay.
Yeah, the buyers programs you're talking about, the TFSA and others,
Yeah. Yeah.
they're similar. It's just that there really isn't much to them other than giving you access to cash for down payment.
Okay.
You know what I mean? Right? Whereas the equity sharing is more, in my opinion, more consequential because it opens the door to capital gains on your principal residence, in my opinion.
Okay. And capital gains has a negative connotation for me. Is that what that's what you're
Right.
saying? Okay.
And,
So
and they're not calling that. They're smart. They're very smart about how they've done it. But this is the way change happens when they creep things in very gradually. So it's just first time buyers up to a certain price range, CMHC insured. But that's how things start. No government's going to put capital gains on principal residence, but they'll call it another name, spin it, and it's the same thing so far.
Yeah, I see. Okay. And that's, do separated spouses qualify after a certain period of time of not buying a house or for this equity sharing piece? Like same with the home buyers plan thing?
I'm not sure. I don't know about that. I don't know what equity portion the government takes, and I don't know the mechanics of that. So I'm not sure, not quite sure on that.
Interesting. All right. Any other questions that the audience has? I've asked a million here. I'm sorry. If anyone has some, they can unmute or put in the chat.
Hi, it's Linda.
Hi, Linda.
Hi, sorry, can you guys hear me okay?
I can. Yeah.
So I just have a question, and hello, Demitry. I just actually am about a year on with my real estate license as well as doing mediation. So just when you were chatting about the value of the homes. So when we're doing it for mediation, would we take into consideration the valuation and then also do one of the approaches when we're trying to give a determination of what the spouse that is interested in buying out would be? Because I guess with in real estate, the way that I've been sort of mentored with it is that we take the evaluation, so the value, and then we usually explain to the client that the value is different than what the actual buyer will buy at the present and current time. They don't always match. So I was just wondering what your opinion on that would be for the mediation part with the spouse trying to buy out.
Yeah, so if I understand the question correctly, so first of all, if there's two valuation dates, they could be the same or they could be different if the market has changed. I hope I understood the question correctly, but I think what you might be talking about is whether there's disposition costs built in or taken out. So if there's a buyout from one spouse to another, we normally remove the real estate commission. We do that because it's a private sale. So normally what we do is if it's 5% real estate commission in that area, we take half off. So if it's worth $1 million on appraising value, remember all those sales you saw in the appraisal report are real estate transactions through agents, MLS. So there was real estate commission embedded in that price. So normally what I do is I take off 2.5% if one spouse is buying from the other because it's a private sale. So there's market value with disposition costs and there's market value for private sale, right? If you didn't do that, then one spouse would be overpaying to the other spouse. Is that what you meant? I'm not sure. I hope I apologize if I missed.
No, but that was interesting. I was like, oh, well, that's cool.
Yeah, I'm kind of interested in that too, Linda, but maybe ask your question again.
Yeah, maybe I'm just asking it the wrong way. So, okay, so if I was to, okay, so I'll put my real estate hat on. So if I was going to say, okay, this is the value, and I went through all, because I'm like yourself, like it's all about the math and the facts and the proof. It's not about feelings. So giving the someone, okay, so let's say for instance their home value comes in at $1 million, but then in the market today and their surroundings, taking into consideration location and other factors, the buyers that are purchasing in that area, maybe the homes going that are almost equal apples to apples for them, are only going for about 850 to 900. So
Mhm.
my question, I guess, is when we're trying to give a proper figure or an approximate for the spouse that would like to buy out the other one, are we setting ourselves as at the valuation, or are we setting ourselves like at that real estate end of what the buyers are willing to pay at this given time?
Right, okay, now I think I understand. Okay, so I apologize.
No, that's okay.
They should be the same thing though. So if the homes are selling for 800,000-900,000 and there's an appraisal for 1 million, then one is wrong. So it looks to me like if they're selling for 800,000, the appraisal is wrong. That's what it sounds to me like, because there should be no difference. If we're talking about a point in time, valuation is point in time. We always say as at, never as of. As of infers as of today and tomorrow. We don't know what's going to happen tomorrow. So as at today, it's worth $1 million. If that's what the appraisal report says, but they're all selling 800,000-900,000, unless that's a special property that's bigger than the rest or something, it sounds to me like it's just a wrong, to be honest, a wrong appraisal, incorrect valuation number.
Okay, so like you said, so at any point in time, they should be very close and within whatever or identical. Otherwise, there's something that maybe is miscalculated, or somewhere along the way, something's gone wrong.
Right. So rule of thumb is generally 5 to 6%. In the recession years, when there was properties that were either possessed by the bank or otherwise, they would order 2 appraisals. If they were within 5%, then they would just call it the value, whatever, take the midpoint or whatever they would do, take the average. If they were more than 5% out, they would order a third. Right. So the 5% rule I've been hearing for decades now, a long time. That seems to be the rule of thumb everyone uses in the valuation realm anyway. So.
Nice.
Oh, no, that's perfect. Thank you. And thank you for the 2.5% taking off the commission, because that was good too. I agree with you, Marianne. That was a good one.
Yeah, it was kind of, yeah, that was interesting.
That was interesting.
I'm going to have to look for that on the valuation reports, because I'm not sure that I would have tweaked to that. So I want to thank you very much, Demitry, for spending this hour with us. It was very informative and a little bit of hope in our days midweek. I think it's really nice to think that the economy may shift around and help out both ourselves and our clients going forward. So thank you very much for your time. And if anyone wants a copy of Demitry's slides, he's more than welcome to share them with you. So just email me at my normal director email, and I'll pop them over to you later this afternoon after Demitry has a chance to send them over. So once again, thank you, Demitry. I appreciate it. Enjoy the rest of your day, everyone. And we'll see you all again next time.
Thank you for having me. Thank you so much.
Thank you so much.
Take care.
Okay, take care. Okay.
Thank you. Bye.
Thanks. Bye-bye. Bye.